Are you looking for a friend in financial services? Well, you've come to the right program. If you're looking for unadulterated, absolute truth about your investments and the economics behind them, the Master of Money program is built for you. Tonight, we're going to be talking about the very foundations of money, whether your money is actually worth anything. So make sure you stay tuned for this edition of the Master of Money. This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. Tonight's special guest is Mr. Doug Roberts, principal of Channel Capital Research and author of Follow the Fed. Tonight's Master of Money program was produced Tuesday, April 7th, 2015. Hello again, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and what a pleasure it is for me to join with you every Tuesday evening to provide the content you need to build a better path to prosperity for you and your family. Now, tonight, we've got a really interesting program. We're going to be talking about the foundations of money itself. Where does the real value come from? We think this is a question that so many people have. And frankly, my friends, there are so many charlatans feeding off the fear people have about currency values. We want to give you the truth tonight. So this should be a very important show for you. Now, I've mentioned before, if you'd like to see archives of the Master of Money or the safe insights that we provide, you can always visit the Safe Financial Network. Simply go to www.safefinancial.org and click on the Safe Financial Network, and you'll have an opportunity to see all of our archives, and we wish you good luck in doing that. I also want to mention, a lot of times I get referrals to friends and family who see the program. We urge you to reach out to your family and friends. If you find this program interesting for you, well, they might for themselves too. So reach out and tell them about the Master of Money. Now, last week we talked about 401k plans, and we answered the question, have 401ks worked? There's a lot of research going on in the academic world today, and a lot of politicians saying that 401ks haven't worked, and we need to restructure the entirety of the thing, including possibly nationalization. Well, we talked about the three big things: the lack of investor education, the lack of the forced retirement savings on people, and the economics behind company matching programs for employees. Now, in addition, we gave you the solutions to these, and we hope you had a chance to take that to heart. But as always, if you have questions about our program, please write us at questions@safefinancial.org. And once again, if you'd like to view that program again, go to the Safe Financial Network, and you'll find the archive there for you or for anyone you'd like to share it with. Now, tonight, as I said, we're going to be talking about the value of money, and that question came up from a viewer. As you know, each week I look to our viewer comments and questions, and I had an absolutely spectacular question last week, and I want to read it for you. It came in from a young man named Christopher, and he wrote to us, and he said, as I understand it, money used to have a tangible backing, such as gold or wheat, which lent the money its intrinsic value. My question is, where does the value in the money we use today come from? I had a conversation with some folks on this subject, and nobody has, in my eyes, come up with a satisfactory solution. Logic doesn't answer the equation. I've heard about faith in the system, but debt, there's no backing. Where can I find a satisfactory answer? Well, after a great deal of thought, I wrote Christopher an extensive email, and that question generated tonight's program. In our second half, we're going to be talking with Doug Roberts, the gentleman we've introduced you to before, who wrote Follow the Fed. We think we're going to be able to give you a very clear response to that question of where does our money get its value? Now, this last week, as we move into the geopolitical world, what a week it was. You know, sometimes I just get a chance to write you or talk to you, and there's too many things for me even to put into this segment. But last week, clearly, the number one thing that happened in the world is the United States coming to tentative agreement with the Iranians on a nuclear deal. Now, you can argue this good or bad, But it's clear that the United States administration is shifting allegiances from our traditional alliances in Western Europe to an Eastern European stance, from Israel to an Islamic State stance, and even in the Far East, from Japan and Australia to China. You could argue this good or bad, and the master of money is not about the politics of it. But you cannot deny that it creates an instability in those regions that's dangerous. We continue to monitor the situation virtually every hour that goes on in Yemen, where the Saudi Arabians and now the Pakistanis have put forces. Those forces are against the Iranian forces who are in Yemen. Well, if the Pakistanis and the Saudi Arabians are against the Iranians, we're behind the Iranians when it comes to fighting ISIS. So I guess it was true. The enemy of my enemy is my enemy, friend. I'm not sure where we stand, but it's a very, very complicated situation. So stay tuned to the Master of Money for the latest and the important information about that. Secondarily, I thought it was interesting to note that the relations between Western Europe and Cuba have begun to thaw. As we spoke about in prior editions of the show, Cuba has had more of an opening of relations with the United States. And to the extent we can ship American product into Cuba, that could be a multi-billion-dollar exercise. Some of our food companies, for example, stand to gain a great windfall from shipping product into that beleaguered island. Well, just last week, the European community began to open up relations with Cuba. We know they're looking at the same markets we are. So we hope that our State Department will manage this properly and give American companies a leg up when it comes to doing business and trade for those wonderful Cuban cigars. Looking at the economic world, here we go again. We've talked about the bipolar economy. We started to think we were the little engine that could. Well, last month, the employment numbers for March came out with a dismal number of about 125,000 new jobs, way down from the 200,000 expectations we had and the trend that had been established. In addition, manufacturing numbers, according to most of the surveys, died off significantly in March. Well, that gives a plug to this economy that's going to slow it down. We keep talking about the worry of the Fed raising rates. Coincidental with those two releases, the Fed stood by its stance that late second quarter or early third quarter, it's going to begin raising rates. These create huge questions for you in the investment world. Where do you stand in your bond allocations? Where do you stand in your equity allocations? Well, stay tuned to the Master of Money as we continue to monitor that for you. Looking at the financial markets, we had a very interesting week in which we saw a real blip up in the middle of the week as it looked like we would have positive moves in the Iranian situation. But toward the end of the week, things dialed back down. And we ended up with all three of the major indexes staying fairly level, not a lot of movement in those. One of the things we talk about regularly is not to panic in the markets. If you see something running up or running down precipitously, don't you dare let your emotions get the best of you. Use the numbers for what the numbers can be. And then finally, I want to highlight once again that this market that we've all ridden up from 6,500 to its current 18,000 and made a lot of money, it's getting a little bit in the pricey area. Valuations stand at about 19.5 times earnings, which historically is a little high. But when you consider those earnings or that PE multiple in light of zero interest rates, well, it makes the market not quite so unattractive. But all of us want to watch the interest rates that come out of the Fed. If they do start to project raising those rates, that could hit the market. So you want to stay with us as we continue. But all of the geopolitical, economic, and financial issues that we talk about right now are showing instability in the markets. And as you've heard me harp on time and time again, it just says you need to find better and better risk controls. Let's not lose sight of the fact that you want to ride your winners, but you want to cut the losses should they turn around quickly on you. In addition, keep your bond duration short because as interest rates do begin to rise later this year, bonds have an inverse relationship with interest rates. Interest rates go up, bond prices come down. Now, in the second half of the program, as I said, we're going to dig into the very nature of all of this. We're going to talk about the value of money. I want to talk to you because there are a lot of people out there who are approaching folks and scaring them about the value of the US dollar. Well, they do that to get them to buy into one of their investment schemes. Some of those are decent. I don't deny that they have value. But to scare people into it puts them into an overweighted position in those commodities or whatever they might be. We don't want you to do that. So stay with us for the second half. We're going to have time with Doug Roberts, as I said, and we're going to go through the nature of the value of money. Well, thanks as always for joining us for the Master of Money, and we will be right back after this quick break.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the Master of Money, everyone. I hope you enjoyed that short clip that we offer. You know, this program was built to provide you the information you need to build a better path to prosperity. And sometimes that information helps you avoid the charlatans that feed on fear, uncertainty, and doubt to steal the money from people that they earn. Well, one of the biggest things they're pursuing these days is to scare you about currencies. They're trying to tell you the US dollar will collapse, and that's going to destroy with hyperinflation all that you own. Well, is this true? Or is this just a circumstance where people are trying to scare you out of their money by selling you some investment product that may or may not make sense for you? Well, tonight we're going to answer these questions for you, and we're going to put a tangible framework around what money is, how values are set, and why you can feel confident that the greenback is going to stick around. Well, let's look at the core fact. Money is truly anything that transfers value from one person to another. I mean, let's go back, and we're not going to do a history lesson here, but let's go back to the barter system, right? I'm the blacksmith, I make horseshoes for horses. The baker says, hey, I need a horseshoe for my horse, and I say, I need a loaf of bread, so I'll trade you a horseshoe for a loaf of bread. It's pretty convenient. But what if the baker doesn't need a horseshoe? How does he then transact with the blacksmith? Well, in response to that, we created money. Money, in fact, can be anything. It can be a silver coin. It can be a gold ingot. It could be a bushel of wheat. It could be a Bitcoin in this new technology-driven world that we have. The fact is, it can be anything that people agree sets value to what they want. I mean, in point of fact, if I could take a pillow out of my house from my couch and persuade the grocer to take that pillow in return for a basket of apples, well, if he could take that pillow and give it to the truck driver, and then the truck driver in turn give it to the farmer, that pillow would be currency. There are countless examples in history of where it's gotten silly like this. I think it was the 16th century tulip bulbs became the currency of favor in the European area. Sorry, this is a fascinating story, by the way. tulip bulbs became such the craze that people were spending entire life savings just to buy a tulip bulb. Now think about it. You can plant them, you can grow them, you can do anything you want to a tulip bulb, but it became the currency of the day. 15 years ago, the 1990s, do you remember Beanie Babies? These little factory-made things, and people were bidding up the prices on these things to astronomical levels. But if people perceive value, then value in fact is there. Now, global macroeconomic issues are a little more complicated, but not much. And to roll the clock forward really quick, let's bring the world up to the 1940s. After World War II, when the United States was the sole economic superpower left in the world, we were largely unfettered by the war. We thankfully hadn't been bombed into oblivion like so much of the world. And so after the war, at a place called Bretton Woods, the world came together and decided how to handle global trade. Initially, they wanted to have global trade become a world currency. But the U.S. fought back on that, and because of its economic strength, it was decided that the U.S. dollar would become the world currency. And that's how we attained first that reserve status. Now, in return for being the world currency, the Bretton Woods Agreement called for the dollar to be immediately convertible into gold at $35 an ounce. It was a fixed rate. That is the genesis of the phrase that the American greenback is as good as gold. So from 1946 to 1971, the U.S. dollar was fully backed by gold. It seemed to give stability to the world, it facilitated trade, and in an environment when the United States was the manufacturer to the world, it gave us the most economic power. Go to 1971. Richard Nixon's president. We came out of the 1960s with the evolution of the Great Society programs of Lyndon Johnson. We were embroiled in the Vietnam War. As a result of these increasing government expenditures, Richard Nixon took us off that fixed gold standard and decided to let the U.S. currency float against other currencies. Well, that's what created this issue of a fiat currency you hear so much about. There's no underlying value to the dollar. It's simply valued relative to other currencies. So roll the clock forward. Here we are in 2015. That dollar that you have in your billfold has been floating against other currencies since 1971. Well, one of the big things you hear people talk about is the deflation that's taken place on the dollar. But let me give you some numbers to put that to bed. From 1946 to 1971, the inflation rate in the United States ran at about 2.6% on average. From 1972 to present, it's run at about 3.6%. The fact of the matter is inflation isn't generated through these fiat currencies as much as it is through war itself. And as we've not had a major world war, inflation has largely been under control in the developed world. Now, as you look to the safety and stability of your dollars in your pockets, I want you to think with me for a moment about where you'd rather trust your money. Would you want to trust the European Union? They're in turmoil right now. We've talked about that with the Grecian problems, with Russia in the east. Would you want to trust your money to Chinese currency, where they've built a bubble unparalleled perhaps in the world with their real estate development? Or do you want to trust the United States with your money? And let me give you important statistics on that. Yes, the United States is now the #2 economy in the world in size. China has beat us in that. But that's not really a surprise. China's got, what, 3, 4, 5 times the population we do? But the more interesting statistic you should be aware of is while we may not be the biggest economy in the world, we are far and away the most productive economy in the world. Our economy is 4 times as productive as the Chinese economy. So when you look at the productivity of the United States and add to that the fact that we have the most powerful military in the world by a large margin, our trade routes are protected and our trading partners know that they're protected. So we have the most productive economy, we have the most powerful military in the world, and we still have the manufacturing base. The difference today, we manufacture high-tech products. We don't manufacture bumpers anymore. We don't need to. We offload that to robots. So we still manufacture the high-powered goods of the world. And fourth, for all of the bad press it gets, The United States still far and away has the best educational system in the world when it comes to post-secondary education. So when you look at the most productive economy, the most powerful military, the manufacturing base we have, and the educational base we have, and throw into it that for all of our bumps and bruises, the United States still has just about the most stable political system in the world. Put all those together, where do you want to trust your currency? Well, in my way of thinking, the greenback still holds the value, and that's supported. If you look around the world today and you look at where the very wealthy people put their money when they're scared, they don't put it into gold. Yes, they have some allocation there. They don't put it into silver. Again, they have some allocation there. They don't put it into overseas land. Maybe they've got some allocation there. They put their money in U.S. currency. They do that through treasury bills, which are short-term loans to the government, or they just buy cash. And the reason they do this is because the United States is still the biggest, baddest economy in the world. We are still the number one, even with all of our flaws. So as we've rolled forward, the U.S. currency today is based on the full faith and credit of the United States. That's all of us. Are we able to pay our debts? You bet we are. You hear all the time these Washingtonian political beings talk about breaking the bank by not lifting the debt ceiling. The fact of the matter is paying interest on the debt right now is about $200 billion off of an income to the government of about $3 trillion. So only about 1/10 of the budget goes to pay interest. We are not even close to default on our debts. And we look at the $19 trillion in debt. Do you want to compare that to our assets? Let's call it what it is. We don't compare a $19 trillion debt to a income statement. You compare it to a balance sheet. The United States today holds well over $100 trillion in assets against that debt. We're not even close to a financial breakdown. We have path problems. I know that. We've got to change our ways. We can't sustain this forever. But we have the stability and the time to make it right. Now, tonight, we're going to bring onto the program Mr. Doug Roberts, chairman of Channel Capital Research, Doug is author of Follow the Fed and numerous other papers that have been highly regarded by the academic and practitioner community. So Doug's going to talk with us about his perspective on the power of the Federal Reserve and the U.S. currency. We'll go to our interview right now. Well, Doug Roberts, thank you once again for joining us on the Master of Money program. As author of Follow the Fed, one of the premier books explaining how the Federal Reserve works, you are the go-to guy to explain to people the conversation we're having today. So welcome aboard and thanks for being here.
Thanks for having me on, Steve. Always a pleasure.
All right. Well, as we've been discussing today, a lot of people come to me with questions about what the value of money is. They're worried really about two big things. Number one, the possibility of hyperinflation if our dollar has no core value. And they talk about the U.S. dollar as the reserve currency and how that might be affecting us. So I wanted to bring you on and get your thoughts on those two big issues.
I guess really the value of a currency is determined by the supply, but also really the industrial capacity and productive capacity that backs it up. So therefore, if you take, let's say, everybody's complaining about the increase in currency in circulation here in the United States, and that it could lead to inflation. That is a very, very different situation from, let's say, a country like Greece, which is also in the news. Because Greece is not a self-contained industrial entity. It right now depends upon other countries for productive capacity. It depends upon other countries to sell to, and it's highly linked with that. Also, the currency itself is denominated not in its home core value, not in a drachma, but in the euro. So therefore, there's a constraint on it that you don't have here in the United States. The United States, it's linked in dollar currency. We really don't borrow any significant amount in another currency. Plus, we have productive capacity that can back it up. If, let's say, the currency goes down, then at that point, substitution can occur in the United States with things there. It may not be the most productive or the cheapest or the most efficient way to do it, but it can be done. The real problem we got into with inflation before was really during the 70s when we were dependent upon foreign oil, and there was a restriction placed on that, and substitution couldn't occur very rapidly. As we've seen today, that's a very, very different situation where we're pretty much either energy independent or on the verge of energy independence.
So when people talk about this hyperinflation because the Fed is overprinting our money, it's really a phantom fear that people don't need to worry about.
It could be something if you had another situation, but right now, currently as we are, unless there's a severe interruption in trade, we're basically, let's say, because of a wartime situation, international trade basically ceases and there's a huge hiccup, which had happened during, let's say, World War II, where we quickly went from a period of deflation or basically moderate inflation to basically severe inflation. That was really because of the restrictions on international trade that occurred during World War II. And the big uptick during inflation really from the 70s was basically interruptions of oil supply, which we were heavily dependent upon. Right now, even if there's a war in the Middle East, we still have an abundance. You could have inflation, but the hyperinflation that people are talking about is unlikely to occur. Also, we don't have foreign debts that are denominated in another currency or denominated in gold, such as that was essentially what Weimar Germany had, pre-World War II, and which led to the hyperinflation.
So,
no matter what you did with your currency, you couldn't devalue the debt or what you needed to buy overseas.
So it becomes a vast oversimplification for some of the fear mongers to come out and say, run for the hills, the U.S. currency's dead.
Yeah, no, I think it does. I think there are some severe distortions. The Fed's balance sheet is of concern, but you have to realize that one way the Fed's balance sheet could be done is they could just increase taxes across the board. And one way you could conceivably do it would be to increase taxes on basically foreign earnings of U.S. companies. Now, I'm not saying from a judgmental point of view that this is the right way to do it. I'm just saying that there are ways to do it. In terms of capital flight, let's say to gold or other currencies, you can institute some form of capital control, such as outlawing or at least having a high taxation on basically holding gold.
Well, they outlawed it in World War II, right around that time, as you've often said.
It was actually prior to World War II. It was actually one of the first actions that Franklin Roosevelt did when he became president. So you can say, well, it's undesirable to occur, but it has occurred. Something similar has occurred in the past, and basically the United States was able to survive. But again, all these things cause distortions, but we've already been distorting the system as it is, and that just benefits certain sectors of the economy, certain sectors of the market, and penalizes other ones.
Right, so retirees who are trying to save money are getting hurt, while those trying to borrow money to build or to leverage themselves up are getting helped.
Yeah, that's essentially one of the big distortions that we've seen right now with the expansion of the Fed's balance sheet, is essentially we reward borrowers or people who are leveraged, and we penalize savers. It's the so-called risk trade. We force those people to basically take on undue risk. The unfortunate thing about it is really there's been no discussion of this. This has really been, done unilaterally without any, and, it was even billed as the intended purpose was to stimulate the economy, and really all it's done is helped a very, very small segment, which you can argue has not really increased the productive capacity nor the employment situation in this country.
We could have an anti-bank show someday. But before,
no, I'm not saying there. Again, you really can't. Yeah, I always say with what I do, I have to separate at the door what my beliefs and judgments are and look at it as a scientist and just say, what are the effects occurring, right or wrong, and interpret that totally separately from whether I believe it's the right thing to do or the best thing to do, because that's,
I'll
as
tell
you
you,
said,
Doug,
it's a different discussion.
Contained in that statement is the wisdom people need to hear, because finance is very dangerous when tied to emotion. And we talk all the time about letting the numbers speak for themselves. Don't get tied up into any of these other things. Before I let you go today, I've got to pin you down. we hear a lot of talk about the Fed coming out in maybe late second, early third quarter, raising interest rates, and it's got the markets awfully afraid. What's your take on that?
It really depends upon the employment situation and what the numbers come out. I believe the Fed probably may want to initiate some type of a small rate rise, but that could be very, very minor. And actually, Bill Dudley, the vice chairman of the FOMC, has said, in essence, that's going to be, a very, very slow process if it occurs and very, very graduated. The analogy that I would say is for people who are looking like something like 1994, this is going to be more analogous when and if it begins as to moss growing on a tree. You're talking about very, very small increments. It may not be there may be several meetings in between, and the ultimate level that they're going to do is going to be lower. So at that point, if you see things being raised, you may see it being done very, very, very slowly.
Well, that again, there's a lot of logic to what you're saying, and I think it overcomes the fear people have of this massive spike in rates that'll drive the market straight into the toilets.
Well, it could be a danger if the economy and liquidity deteriorates. Is one of the things the potential shocks is right now a lot of QE is flowing overseas into the United States, into the U.S. market to really offset this tightening or this phasing out of QE and also possibly conventional tightening. If something happens overseas to disturb that, then you could have a real serious problem. And if we look at it, that's really what happened 2007, 2008, is at that point it was a small overseas subsidiary of AIG that announced they had a problem and essentially creating a domino effect, which would render some major financial institutions in the United States insolvent. But essentially, the Fed had no warning, and Ben Bernanke even talks about when the discussion was held. He really didn't want to bail them out, but he saw no other alternative.
There was none. Well, I certainly, Doug, appreciate your joining us today, and to all the masters of money. You can see why I have Doug on. He is truly an expert. And by the way, don't forget to go to Channel Capital Research and check out that book, Follow the Fed. There's some really good insight and information. So, Doug, thanks again for having her be on the program, and I look forward to having you on once again.
Thanks very much, Steve.
Doug, thank you for that kind interview. It's always a pleasure to have the experts on the Master of Money that we bring you, whether it's Tim Newell from Harvest, Jeff Garbaz from Superstock, or Doug Roberts from Channel Capital. These are people who truly know their stuff. They're respected in their industries, and we urge you to write us at questions@safefinancial.org if you'd like to get more information about those guys. Now, again, I want to thank Doug. I want to thank all of our sponsors, Harvest Investment Services and Superstock, for being with us. We bring this program to you each and every week to help you. Well, let us help you by writing us at questions@safefinancial.org always. And don't forget to go up on the website and visit the Safe Financial Network. All of our work can be seen up there, and we bring it there for you. So next week, we'll be back to see you once again with another edition of The Master of Money. But until then, we wish you the most prosperous and happy week possible.